The letter arrives before the markets can brace for it. On the morning of January 7, 2009, investors wake up to a confession that strips the numbers bare. Years of reported profit vanish in a single admission. Cash that looked solid on paper never existed. What had been sold as discipline, scale, and global success collapses into fraud. At the center stands Ramalinga Raju, the respected founder of Satyam Computer Services, admitting that the balance sheet was a lie he could no longer control. Trading halts. Phones light up across Mumbai, New York, and London. Employees arrive at offices that feel suddenly hollow. Clients question contracts signed in good faith. Regulators scramble for answers they should have demanded years earlier. This is not a single bad quarter. It is a system built to deceive. The question is no longer how the numbers fell apart. It is how the illusion was allowed to stand for so long and who chose not to look too closely while the money kept flowing. Chapter 1. The Numbers That Would Not Hold. On January 7, 2009, the Indian stock market opens under strain. Before most traders finish their first coffee, a letter begins circulating through regulatory offices, boardrooms, and news desks. It is short. It is direct. It admits what no one wanted to hear. The chairman of Satyam Computer Services says the numbers are false. For years, the company reported steady growth. Revenues rose quarter after quarter. Cash balances looked strong enough to weather any downturn. Analysts praised discipline. Global clients trusted the books. Pension funds and institutional investors treated the firm as a safe proxy for India's technology boom. The letter erases that confidence in minutes. The author, Ramalinga Raju, writes that the cash shown on the balance sheet does not exist. Bank balances were inflated. Revenue was overstated. The gap between reality and reporting grew slowly, then all at once. He says the hole became impossible to fill. He says he lost control. Trading in the company's shares is halted almost immediately. The stock had already been sliding, but this is different. This is not a bad quarter or a missed forecast. This is a confession. Inside Satyam offices across India, employees arrive expecting a normal workday. There are no clear instructions. Managers have no answers. Email servers are flooded with messages from clients asking whether contracts will be honored. Some projects continue out of inertia. Others stop when payment approvals freeze. In Mumbai, regulators move fast, but not fast enough to stop the panic. The Securities and Exchange Board of India issues statements calling for calm while demanding documents. Banks are contacted to confirm balances that, until hours earlier, were taken at face value. What comes back does not match the books. The claimed cash position is billions of rupees higher than what banks report. The difference is not a rounding error, it is a structural gap. Global markets react within hours. American depository receipts plunge. Hedge funds unwind positions. Analysts scramble to revise reports they wrote only weeks before, many of them based on management guidance now revealed as fiction. The speed of the collapse exposes a deeper problem. Satyam was not a small or obscure firm. It was one of India's largest information technology services companies, serving clients in finance, manufacturing, and government sectors across multiple continents. Its financial statements were audited. Its board included respected figures. Its growth story was cited in international business schools. None of that stops the fall. By mid-morning, television anchors begin using comparisons. Some call it India's Enron. Others say the scale is different, but the shock is the same. Investors believed they were looking at a disciplined, boring success story. What they were actually buying was an illusion held together by trust and inertia. Behind the scenes, officials begin reconstructing the timeline. The first task is simple in theory and brutal in practice. Determine what is real, which contracts exist, which revenues were earned, which clients are still paying, which employees are essential to keep systems running. Every answer creates new questions. The letter claims the fraud built up over years. It does not specify exact dates. It does not explain how falsified numbers pass through internal controls. It does not name accomplices. It frames the deception as a personal failure that grew beyond repair. Investigators do not accept that framing at face value. They know that financial statements of this size do not fabricate themselves. Cash confirmations involve banks. Revenue recognition involves customers, invoices, and project milestones. Audit processes rely on sampling, controls, and representations from management. For the numbers to be wrong at this scale, multiple safeguards had to fail or be bypassed. Outside the company, clients face immediate risk. Outsourced systems run payrolls, billing platforms, and customer databases. If Satyam collapses overnight, operations across continents could stall. Governments quietly urge continuity while preparing contingency plans. Inside the firm, fear spreads faster than information. Employees worry about salaries. Middle managers worry about arrests. Senior executives avoid phones. Some begin deleting files. Others begin copying them. Regulators request emergency board meetings. Independent directors resign within days, citing lack of information and breach of trust. Their departures deepen the sense that the structure at the top is hollow. The attempted explanation arrives too late to help. Raju says the gap began small. He says false profits were used to hide earlier shortfalls. He says the problem compounded each quarter. This is a familiar pattern in financial fraud, but familiarity does not make it less damaging. What makes this moment different is timing. The global economy is already under stress. Financial institutions are fragile. Investors are sensitive to any sign that balance sheets cannot be trusted. A major fraud in one of the world's fastest-growing economies lands at the worst possible moment. By the end of the day, the question has shifted. It is no longer whether Satyam's numbers are wrong. That is settled. The question is how the system allowed it. Why did auditors not detect the gap earlier? Why did banks not flag discrepancies? Why did analysts accept explanations that now look thin? Why did the board approve transactions without demanding deeper proof? The answers are not yet clear, but the pressure is building. Late that evening, government officials hold closed-door meetings. Allowing the company to fail outright would destroy tens of thousands of jobs and damage confidence in the entire sector. Propping it up without accountability would send a different but equally dangerous signal. They decide on a temporary path. Stabilize operations first, investigate next. For employees watching the news from their homes, the future feels uncertain and personal. Many joined Satyam, believing it represented the promise of Indian technology on the global stage. Overnight, that promise looks compromised. For investors, the damage is already real. Market value erased in hours will not return easily. Lawsuits are inevitable. So are criminal investigations. The letter that started the day was meant to explain. Instead, it exposed how little anyone truly knew. As midnight approaches, investigators reviewing preliminary data reach a grim conclusion. This was not a sudden collapse triggered by market forces. The numbers did not break. They were built to deceive. And once the deception was exposed, there was no structure underneath strong enough to hold the company up. Chapter 2. Building the illusion. The collapse makes one fact unavoidable. The deception did not begin at the end. It was constructed patiently, quarter by quarter, during years when India's technology sector was racing to meet global demand. In the early 2000s, outsourcing explodes. Western companies look for lower costs and skilled labor. Indian IT firms expand fast, competing for contracts that promise scale and prestige. Growth becomes the currency that matters most. Miss it, and markets punish you. Hit it, and scrutiny fades. Inside Satyam Computer Services, pressure builds quietly. Public filings show rising revenue and strong margins. Internally, cash flows do not always match the story. Small gaps appear. They are manageable at first, a delayed payment here, a cost overrun there. Instead of correcting course, the numbers are adjusted. Investigators later determine that revenue is inflated using fake invoices and non-existent clients. Customer accounts are created on paper only. Project milestones are booked before work is completed. Cash balances are padded through falsified bank statements and forged confirmations. The fraud does not require a large conspiracy. It relies on a small circle with access to financial systems and authority to override controls. Once false numbers enter the system, they become the baseline for the next quarter. Each reporting period demands new fabrications to cover the last. Internal controls exist, but they are designed to trust senior management. Finance staff reconcile what they are told to reconcile. Exceptions are explained away as timing issues. Those who ask too many questions are sidelined or transferred. External audits provide legitimacy. Audit teams rely on documentation supplied by the company. Sampling techniques assume underlying honesty. When bank confirmations arrive, they match the fabricated records because the records themselves have been manipulated. This is not proven to involve auditors knowingly falsifying reports. What is proven is that verification failed, repeatedly. Analysts, meanwhile, focus on growth narratives. Satyam presents itself as conservative compared to flashier rivals. Conference calls emphasize discipline. Earnings calls avoid surprises. The story feels safe. By the middle of the decade, the gap between real performance and reported success has widened dramatically. Fake cash becomes essential to justify expansion. Fake revenue supports stock price stability. The illusion feeds itself. The danger becomes obvious to those inside the circle. If the fraud stops, the company collapses. If it continues, the whole grows. There is no clean exit. By late 2008, global conditions worsen. Clients tighten spending. The cushion that false numbers provided begins to shrink. Pressure intensifies. That is when a new plan emerges. In December 2008, Satyam announces its intention to acquire two construction and infrastructure firms, Metas Properties and Metas Infrastructure. The name Metas is Satyam spelled backward. Both companies are linked to Ramalinga Raju's family. The proposal shocks investors. Management frames the move as diversification. Markets see something else. Why would a cash-rich IT firm buy unrelated construction businesses during a global downturn? Why would it use its supposed reserves instead of returning value to shareholders? Within hours, the stock price drops sharply. Analysts question governance. Independent directors demand explanations. Media scrutiny intensifies. Behind closed doors, the intent is simpler. The acquisition would absorb fake cash into real assets. It would plug the balance sheet gap. The illusion might survive. The plan fails. Shareholders revolt. Board members withdraw support. The deal is called off within a day. What was meant to hide the fraud instead exposes it. After the Metis episode, confidence evaporates internally. Banks ask harder questions. Auditors request additional confirmations. The market begins to suspect something is wrong, even if it does not yet know what. Raju later describes this period as unbearable pressure. Investigators do not rely on that characterization alone, but the timeline supports the conclusion. Options narrowed, scrutiny increased, the window to maintain the deception closed. When the confession arrives weeks later, it is not spontaneous. It is the end of a failed containment strategy. As authorities reconstruct the mechanics, they identify consistent patterns. Fake invoices routed through controlled accounts, spreadsheet adjustments made late in reporting cycles, cash balances reconciled to documents that never came from banks. What they do not find is evidence that the fraud benefited ordinary employees. Salaries were paid. Projects delivered real value. The deception served one purpose: to maintain the appearance of success. That distinction matters later in courtrooms and policy debates, but it does not reduce the damage. The illusion required silence. It required compliance. It required an ecosystem willing to accept reported success without probing too deeply. Each participant may have believed their role was small. Together, those roles sustained a massive falsehood. By the time the truth surfaces, the damage is irreversible. Investigators now understand how the fraud worked. They still face the harder question: why did no one stop it when the warning signs were visible? The answer does not lie in a single failure. It lies in incentives aligned toward growth, trust placed too high, and skepticism applied too late. As Chapter 2 closes, one fact stands clear. The fraud was not an accident. It was an engineered illusion that survived because it fit what everyone wanted to believe. And once belief replaced verification, the collapse became inevitable. Chapter 3: Fallout, Accountability, and the Cost. By the time authorities step in, the damage is already done. Confidence has collapsed faster than systems can be secured. What remains is a company that still employs tens of thousands of people, but no longer controls its own future. Within days of the confession, the Indian government moves to stabilize operations. The concern is immediate and practical. If Satyam fails outright, payroll systems, financial platforms, and government contracts across multiple countries could grind to a halt. Jobs would vanish overnight. Confidence in the entire outsourcing sector would suffer lasting harm. A new board is appointed under government supervision. Its mandate is narrow: keep the company running. preserve client relationships where possible, cooperate fully with investigators. This is not a bailout in the traditional sense. It is containment. Meanwhile, criminal proceedings accelerate. Ramalinga Raju is arrested along with senior executives accused of participating in or facilitating the fraud. Prosecutors outline charges tied to falsification of accounts, conspiracy, and breach of trust. Evidence gathered includes internal emails, forged bank confirmations, and altered financial records. Courts begin the slow process of separating allegation from proof. What becomes clear early is scale. The falsified cash balances amount to billions of rupees. Revenue inflation spans multiple years. The deception is not confined to a single reporting period or isolated decision. It is systemic. Raju's defense acknowledges falsification, but disputes intent at certain stages. He claims the fraud began as a temporary measure meant to smooth volatility. Prosecutors counter that intent is evident in repeated, escalating actions designed to mislead investors and regulators. The court proceedings take years. Witnesses testify about pressure, overrides, and instructions that flow downward from the top. Audit failures are scrutinized but framed carefully. Negligence is debated, collusion is examined. Findings focus on what can be proven, not what appears obvious in hindsight. Eventually, convictions are secured. Sentences are handed down. They bring formal accountability, but they do not restore what was lost. For employees, the aftermath is uneven. Some retain jobs as the company is sold to a competitor and rebranded. Others leave under a cloud of uncertainty, their resumes marked by association with a scandal they did not create. Career trajectories stall. Trust erodes quietly. For investors, recovery is partial at best. Lawsuits produce settlements that cover only a fraction of losses. Institutional portfolios absorb the hit and move on. Smaller investors feel the impact more deeply. Globally, the scandal triggers a reassessment. Analysts who once praised Indian IT governance begin asking harder questions. Regulators tighten disclosure rules. Audit firms face new scrutiny. Boards demand more independent oversight. The phrase India's Enron enters the business lexicon not because the cases are identical, but because the shock is familiar. A company once seen as safe collapses under the weight of fabricated success. Systems designed to prevent fraud fail in sequence, not all at once. In the years that follow, Satyam ceases to exist as an independent entity. Its name becomes a case study rather than a brand. Business schools dissect the mechanics. Compliance officers cite it in training sessions. Journalists reference it whenever corporate governance in emerging markets comes under question. Yet the deeper lesson is not confined to geography. The Satyam scandal exposes how modern corporations depend on trust layered over complexity. Investors rarely see operations directly. Auditors sample rather than examine everything. Boards rely on information filtered through management. When trust is abused at the top, detection becomes difficult until collapse is unavoidable. What makes Satyam particularly instructive is not just the fraud itself, but how long it persisted in plain sight. Growth narratives muted skepticism. Strong reputations discouraged challenge. Each quarter of apparent success reinforced belief. By the time belief cracked, there was nothing underneath. Years later, interviews with former employees reveal a lingering sense of disbelief. Many still struggle to reconcile daily work they knew was real with financial results that were not. They delivered projects, they met client needs, yet the success they were told they were part of was, in critical ways, fictional. Regulators frame the case as a turning point. Reforms are cited, oversight improves, yet enforcement remains reactive by nature. Fraud evolves, pressure persists. The final cost of the scandal cannot be measured only in currency. It includes careers disrupted, trust damaged, and reputation stained beyond repair. It includes a reminder that systems fail, not because they are weak, but because they are trusted too much. In the final judgment, the court addresses responsibility directly. The fraud is not an abstract failure. It is the result of choices, repeated, calculated, sustained. As the gavel falls, accountability is recorded in legal terms. History records it differently. Satyam becomes a warning etched into the record of global business. A reminder that success without verification is fragile, that growth without transparency is dangerous, and that when illusion replaces truth, collapse is only a matter of time. The numbers did not hold because they were never real, and once exposed, no institution, however large, could pretend otherwise.